Hello, everyone. Thank you for joining us today on another educational webinar on how can you eliminate or mitigate your high capital gains tax or high income taxes. So this is going to be a very educational webinar, and get ready to take some notes and also to ask some questions. We did another webinar yesterday evening, and I heard there was some glitches with the Zoom where chat was not working. I'm not sure if chat is working for this webinar or not, but feel free to add your responses to Q&A section. If you have any feedback or any questions that you want to address towards the end of this webinar, put it in the Q&A section, and I and my team will stay on top of that. Okay, so here we go. As usual, I'll start with the intellectual property notice that the material in this presentation has been prepared by and is the property of KB Tax Deviser CPAs. All contents, including images and impressions, are protected under the U.S. intellectual property and trademark laws. Before you make any decision to shift around things in your tax situations, please speak to a licensed professionals. I'm a qualified licensed professional and a CPA, but I'm not your CPA. So don't just take any actions without getting the full picture of what we are talking about and how it can impact your tax situation. So here, a little bit about us, who we are. We are an industry-leading advisory firm started by two sisters, myself and Taruna, as you can see on the screen. We provide one-stop shop solution for all your tax and accounting needs, with customized, innovative tax strategies to help you live fruitful life, achieve financial freedom, and leave lasting legacy. We serve clients throughout the USA. I often like to joke around because, we are not your average CPA firm. We are a team of tax strategists and CPAs who are on a mission to empower smarter tax and business decisions. I'm proud to say we have been rewarded as a best accounting firm in whole Lehigh Valley by Reader's Ranking Award for 2 years in a row. Little bit about myself. My name is Minal Babaria. I'm a CPA, certified tax coach, and just recently last week got awarded certified tax strategist designation. I have more than 15 years of tax industry experience. There are millions of accountants in the USA. However, not everyone is certified tax strategist like me. As a certified tax strategist, I'm extensively trained in identifying deductions, loopholes, credits that saves my clients tens or hundreds of thousands in taxes. Proud winner of the Gold Stevie Award for Women in Business in Accounting and Finance category, winner of 40 Under 40 by CPA Practice Advisor Award, and I'm also serving on Intuit Tax Council member board. And I'm proud to announce this publicly this time that I'm a multi-family investor with 624 doors across multiple states. I know many of you were present in our last evening's webinar where we presented our Dallas-Fort Worth opportunity, 80 door units, and we are doing capital raise at the moment. So if you were there, I really want to appreciate you. And if you weren't there and would like to learn more about this opportunity or would like recording of that webinar, please reach out to my team and we will be happy to send you the recording of that webinar as well. So, I just wanted to bring this in, how I got started. There are so many accountants doing the similar things. Everyone have different why. My number one reason that I got started was because of my dad. He owned multiple businesses, but he struggled without financial advice and proper tax strategies. Every time, business owners have that question, am I doing everything that I'm supposed to do? Am I, taking all the tax deductions available to me? Is my accountant doing the right job? Would not, all of this, my dad had the same questions. So at the age of 17, when I began my work as an accountant, I realized that most of my colleagues only offered tax return preparation and not the information that the business owners really needed to grow in all aspects of their business life. So that's when we sisters began our own firm. We provide small business owners with the strategies that will enable them to reduce their risk, maximize their returns, scale revenue, and build lasting wealth and family legacy. And I'm proud to say my both the sisters have joined me in this mission, and we all three sisters are CPAs. We just don't want any other family to suffer like our family did. I just wanted to go over some of this tax jargons, tax avoidance. There is a lot of misconception in the industry. So I just wanted to, kind of bring in what is legal and what is not legal, right? So tax avoidance is using the tax laws to reduce your taxes. It is legal to do it. However, tax evasion, it's avoiding the tax laws to reduce the taxes, which is completely illegal. Any tax strategies that you will ever learn in our educational webinars or working with our team, we always go with the legal tax strategies, which could include tax avoidance, tax loopholes, those kind of things. So tax loophole is using the tax laws to reduce your taxes. Yes, there are legal tax loopholes available, which does have IRS tax section code in IRS tax rules as well. And tax fraud, it goes by its name, it's completely illegal to do it. So when it comes to reducing taxes, we try to stay within the legal side of the tax elimination rules, not on the illegal side. We at KB Tax Deviser CPAs, we have developed a system for permanently reducing taxes for the business owners and investors. And after working with hundreds of clients, we have found that people save on an average at least 20 to 40% in taxes in 3 months or less. And we have helped hundreds of businesses save tens or hundreds of $1,000s in taxes. And it has been proven that 100% of the time, the actual tax savings generated outweigh than what was actually projected or promised to our clients. So in the last 18 months, my clients have saved almost $16 million in taxes, which could have been donated to the IRS otherwise. This is how we are minimizing lifetime taxes to create the cash flow you need for investing as well as for growth. So I just wanted to go over in a little bit about what is passive income and what is non-passive income. Many of you may know it, but many people don't really know it. The non-passive income, often referred as an ordinary income or income coming from your active business or active salary, that is all non-passive income. It gets taxed 0 to 37%, 7 different tax brackets depending on the income level. And it also, if you're married or head of household or single, your tax bracket may change. It's coming from the earned income, as I mentioned earlier, whereas the passive income, it's an income derived from the real estate, limited partnerships, investment portfolio income, or any other activity where taxpayer is not actively involved. So, oftentimes I look at, many prospects' tax return who just send it to us for our audit, how well their accountant is doing. 90% of the time I find an error. So if you are not checking this on your tax return, I think you should check, how your accountant is really reporting all the K1s that you receive in the business. Are they reporting it as a passive or non-passive? And are you really actively involved in the business or not? Not all income is taxed equally, and changing the character of your income to suit more favorable tax rate is a core tax planning. So like say, for example, you have a real estate entity, which is passive. You have, majority of the time real estate will have either break even or some losses. So unless you have other source of passive income, those losses are completely unutilized. So it's very important to do the tax planning in a way to carve out some passive income from all of these sources of income that you have available, which will offset your tax losses that are coming from the real estate to kind of get the maximum tax benefit in the year that you are having these losses. So that's kind of, we call it as a tax planning, which we cover more in detail later on. But ordinary income versus capital gain, The ordinary income, the highest tax bracket that is possible, which is 37%. The short-term capital gain tax rates, are taxed at the ordinary income tax rates. However, the long-term capital gains tax could be 0%, 15%, 20%, depending on what tax bracket you are in. And on top of it, there could be, net investment income tax, which is, for passive participation. So if you have an option and when your capital gain is higher, having it in a long-term capital gain tax bracket is more favorable for you versus having a short-term capital gain tax bracket. And again, when you have a higher capital gain tax, your tax bracket is determined based on where your ordinary income hits, what tax bracket your ordinary income is, based on the dollar amount. So lower the ordinary income, lower the capital gain tax bracket. Higher the ordinary income, higher the capital gain tax bracket. And, passive activity rules and opportunities, a little bit to speak about what defines an activity, and is there a material participation or not, and how do we pull off or how do we accomplish or implement recategorization of non-passive to passive, which I briefly mentioned. The first thing you have to look at is what are we evaluating? What is a pool of income or group of incomes? The income itself, what is made up of, and then did we material participate in that income group or not? There are a lot of things that goes in. Most commonly, people define an activity simply by opening up an entity of some sort, and it could be sole proprietorship, it could be a corporation or whatever. And then they just happen to deposit all their business income in that one entity. And by default, they have defined that activity as the core of that partnership or that sole proprietorship. But it's made up of all of these different streams. And people don't really realize it's very important to put right stream of income in right bucket or right entity. Say, for example, if it is a chiropractor, and chiropractor's business, for example, he gets lots of different streams of income. They certainly get some income from seeing patients and from patient visits, but chiropractors also may offer a massage. They may have massage therapists in the office and they charge separately for the massages. They may have a physical therapy going on in their office and they earn income from physical therapy. They may also sell some retail products, things like stretch events and balls and devices, whatnot that you take home for repetitive exercise at home. So, and they may also sell some supplements, right? Now, they may also run some sort of concierge program where you pay one monthly fee and it's unlimited visits to the chiropractor. So each one of these streams will fall into different bucket and could be identified as different activities. But it's up to the taxpayer to define it, else the IRS will define it for you and they will put under one bucket and then look into and see if there is a material participation and if we can fail the test to benefit to your own advantage. Now, for chiropractor, they are classified as specified service trade or business. And if your income combined from all of these sources, all of these sources comes up above certain threshold, you do not even get qualified business income deduction. You lose that QBI deduction dollar for dollar after your income hits certain threshold. Now, when you put all of this income in different buckets, your main income, which is seeing your patients and patient service income, will fall below certain threshold, which will make you eligible to get that QBI or Section 199A tax deduction. At the same time, because you segregated all the other income stream, you will get a separate QBI or Section 199A tax deduction on that income, which otherwise, when you had combined everything, you could have lost it. So it kind of plays a lot of role in that sense. The another one I wanted to bring in is passive activity rules and opportunities. How you can convert earned income into passive income. Identify the opportunity, first of all, as I kind of gave you a brief example of chiropractor. Identify what are the separate streams of income possible and create a plan to segregate some of these streams of income. Income or function is diverted to the separate entity and original business pays fees for service. And there is a lot that goes in, but I just wanted to keep very simple for people to understand for the purpose of this particular webinar. And then comes section 1244, small business stock. If you sell qualifying section 1244 stock at a loss, you can treat up to $50,000 as an ordinary rather than as a capital loss. And when you treat it as an ordinary loss, it can offset your other taxable income, which could be your W-2 income, your K-1, your retirement income, any one of those. And this is possible regardless of the holding period. This means you can use it to offset your ordinary income and reduce your tax by as much as 37% of this proportion of the loss. And just one disclaimer or one warning, the section 1244 applies only if total capital gain invested isn't more than $1 million. So, there are so many different tax strategies that are available for capital gains as well as higher income tax. But there are so many caveats to it. Certain tax strategies are more profitable to do it, below certain threshold or in particular tax situation versus certain are not available for the others. So in reality, like, what is tax planning? The tax planning is something that is done before the year end. After the year end, it's just a process of tax preparation where you give all the documents to your accountant, and your accountant's job is put in the right numbers in the right boxes and call it a day. It's pretty much like working for the IRS, not working for you. However, the tax planning is something it's done before the year end. And it is the process of looking at your personal life, your business life, and IRS regulatory requirements to legally reduce your taxes. And, that's why if you're expecting a huge capital gain or huge ordinary income tax, it's very, very crucial that you make sure that you are making an estimated tax payments on time or early. At the same time, you are reaching out to your accountant and, or your accountant is actually reaching out to you, and you devise a tax strategy, what your actual tax payment is going to look like, how you can reduce that tax payment by taking, advantage of different tax strategies that are available to you. That just reminds me, one of the prospect or one of our client whom we hired this year, that person didn't know about making an estimated tax payment and whatnot. And her accountant didn't even reminded her making an estimated tax payment and whatnot. She's based out of New York. Turns out she just received last week $28,000 bill from the New York State, which is for not paying taxes in time, the estimated tax payments in time. Even though she made the estimated tax payment in December when she, when she came on board with us, that still doesn't count. So it's very important to make sure. Go ahead, Taruna.
That 20,000 is just the penalty alone.
Yeah, that's just the penalty. It does not even include the tax liability.
And so something here, Minal did just say that tax preparer files tax return at the end of the year by putting right amount on the right form, like more compliance. But what we see in every day when we evaluate tax return, that even doing that, I don't think it's reported correctly, because many of passive loss or income is not reported correctly in the prior year. So now that when you receive passive loss, you cannot even utilize that. It just becomes carry forward for unlimited years, and you're not getting any benefits.
Yep. Thank you for adding that, Taruna. So, another thing that I've seen people do is either 1031 exchange or deferred sales trust when there's a huge capital gain. Those tax strategies are good, but not the best. So let's learn about how this, 1031 exchange or deferred sales trust compares with the other tax eliminating tax strategy. The deferred sales trust provides capital gains tax deferment on the sale of your highly appreciated business, primary home or investment real estate. It's kind of a specialized installment sale. You sell your asset to the trust in exchange for a secured installment note. And trust then sells that asset to your designated buyer and receives the sales proceeds. This allows you as a taxpayer to avoid actual or constructive receipt and defers the obligation to pay taxes at the time of sale. So, if at all anything, I don't know about you all, but I do not want to leave my kids with my tax burden. And I don't even want to pay taxes in a future date when the tax rates are going to be higher. Going out of this COVID and budget deficits and whatnot, we all know that the tax rates are going to go high. Why would you defer the taxes to the future date when you can eliminate everything completely right now and be done with it right now? So, that's another thing. And the another tax strategy, which oftentimes people use, which is good, but not the best, again, qualified opportunity zone reinvestment, where you have a capital gain event that you want to defer and potentially eliminate by reinvesting over the next 8 to 10 years. And a qualified opportunity zone funds is a new deferral and elimination method of capital gain taxes on any kind of capital gain sell event. However, qualified opportunity zone will be of no use if you want to use that capital gain or that high income for any other purpose than just putting in this qualified opportunity zone. When you're reinvesting this money in here, you are getting that money for at least next 8 to 10 years. You don't have access to that money. And especially if you are someone who needs access to that money, or who is like, I just sold this business, I need some time to rethink or to do my market research where I can invest this money, or I want to put this money partially in X bucket versus Y bucket. Qualified opportunity zone might not be the best investment for you in that particular case. However, the best tax strategy that we have identified, which has proven again and again for many of our clients, is a family endowment program. It's a program which provides an opportunity to increase the cash flow available for charitable contributions, as well as eliminate capital gains and income tax with transactions of $1 million or more, and is funded with transactions including sale of a business, sale of a professional practice or a goodwill, post-sale or high income taxpayer income tax reduction, sale of real estate, including post-cost segregation study. If you remember, there are many businesses like hoteliers or multifamily units or, businesses which have bought building. They have done cost segregation study to take advantage of accelerated depreciation. However, when they're selling that business, they have reduced basis in the business, which means their capital gain taxes is going to be very high. Or, 1031 exchange, when you do that 1031 exchange and you happen to sell that business in future, your capital gain taxes are going to be substantially high. So the family endowment program can be utilized even on those situations as well. The tax deductible extraction of C Corp retained earnings, sale of stock options. If you're working at a highly prestigious company where you have an option to get stock options and you are expecting a huge, income tax on, exercising your stock options, this particular tax strategy can be useful for that ordinary income tax as well. Capital gains tax on sale of appreciated assets and non-qualified deferred compensation alternative. So this tax strategy has been defined as per publication 526, 561, 1771, IRS tax section code 170F18. So multiple tax section code, we have done sort of research in designing this particular tax strategy. What are the tax section code, through which this is a possibility? So how it really works, if you have a business and you're planning to sell that business, so before the business sale happens, or before your LOI is signed, there are certain steps that needs to happen. So just, take an example that you have a business, you're looking to sell maybe towards the end of this year or next year. So the typical, process will look like you own a business and you're interested in selling the business, which can be an S Corp, C Corp, or a partnership. And this establish a new entity for family endowment program based upon your unique needs. Assets of client's business are transferred to the FEP before the actual sale happens. So if you are planning to sell the business, if you were to do the FEP before, it's the most beneficial. Now, if you didn't have time ahead of time and you're doing FEP afterwards, that is also possible, which I'll cover in next few slides. But anytime you're doing this FEP, doing it before the sale of the business is the most beneficial. So, family endowment program is where you are kind of transferring your business assets prior to signing the binding sales agreement in exchange for you being 1% general owner and 99% limited owner. The key here is 1% general and 99% limited owner. And client transfers that 99% of the limited ownership you had here, that interest to donor advised fund. You're not transferring any money, you're only transferring your non-voting rights, non-voting shares to the donor advised fund at a qualified public charity and enters into a sales agreement for the sale of their business. And once the business is sold and the proceeds from the assets are transferred, they go to the family endowment program, and client pays income tax only on the 1% of the sale as a general owner. So if you have a capital gain of $1 million, for this transaction, 99% of that $1 million will be completely tax-free. Only 1% of that $1 million will be taxed at your own capital gain tax bracket, which will be substantially low. 99% gain goes to the donor advised fund. A valuation of the assets transferred into the family endowment program are valued by an independent appraiser. And usually client receives a deduction for the value of the assets transferred to the FEP and will manage the assets of the FEP as a general owner. So you are in full control of the bank account. You're not transferring any money. You're not transferring any bank account, anything at all to the donor advised fund. It's just that the shares, which are 99% non-voting rights, it goes to the FEP. Rest of the money, your assets, all your bank account, everything remains in your own control. It's just a structure that we have created in that way where you get the maximum tax benefit. And any investments in the entity can be managed by the client or your client advisor, whichever you want. And any gains from the earnings in the FEP, so all the future gains are again taxed at only 1% of the ownership. So if you, in the future, if you have $500,000 of gain, you will only pay taxes on 1% of $500,000 and rest is completely tax-free. So it's kind of like having your own cash flow bank. Instead of donating your money to the IRS upfront, instead of that, you park it in your FEP program. You can borrow and tap on that money as and when you have a need, whether it is a need to buy a real estate, any real estate properties, or to buy, invest in stocks, or to buy any business, anything, it could be possible. And client determines the amount and which charities are funded by the donor advised fund, because there's some charitable component involved and there's a donor advised fund involved for which you're going to get a huge charitable deduction. This strategy does require some minimal charitable donations every year, and you have the full freedom on which charitable organizations you want to donate to, or where, how much money you want to donate. So there is no restriction on that. And client can receive tax opinion letter from the independent attorney for the fixed cost of $5,000, where, tax attorney kind of gives you a letter. They have looked at everything. Everything looks legitimate. And so, when you submit that tax opinion letter from the independent third-party tax attorney, I just kind of gets that peace of mind. Okay, everything that was needed to be done is done. And, you don't get any other additional inquiry or anything like that. And so how it really works pre-sale with a real life example, let's take an example of Cal. His federal and marginal tax rate is 38%. And long-term capital gains net investment income tax rate is 23.8%. So I've done 20% of capital gains tax rate and 3.8% of net investment surcharge, and no other income in the year of sale. He's selling the business for $1.8 million with $952,000 of taxable capital gain. Kyle wants to contribute this $952,000 into the FEP in exchange for 1% voting interest and 99% non-voting interest. The non-voting interest is then transferred to the qualified public charity. The value of the ownership interest donated for the charitable deduction purposes, let's assume it's 75% of $952,000, assuming there is a valuation discount. And at the 37% tax rate, the potential tax savings from the charitable deduction is $1.8 million. So looking at this conceptually, so estimated income taxes, if Carl doesn't do anything, there is no FEP, nothing at all, is $255,000. Estimated income taxes with the FEP is $2,558. As I said, 1% voting interest, which means you're only paying taxes on 1% of the income, which is almost about $2,500, which is like nothing. Estimated reduction in tax is $253,000. The investment for FEP, is $57,000. And estimated cash flow advantage in 2021 or 2022, whichever we call it, $196,000. So for Carl, if he were to do the FEP, he will keep $196,000 in his pocket, even after he pays the taxes, even after he pays, attorney and all the team involved in making this strategy in reality, about $57,000. He still has $196,000 remaining in his hands. And potential cash flow advantage of charitable deduction that is available to him in the year of sale and the next 5 years is $714,000. So that charitable deduction, which is available to him, he can deduct whatever is eligible in the year of sale, and the rest is carried forward to next 5 years. So total potential cash flow advantage for gifting and investment that is available to Carl is $892,000 out of this $952,000 capital gain. That's a substantial amount of money that he's keeping in his hand if he were to do the FEP. And if he's not doing the FEP, then it's $952 minus $255,000, almost about $700,000 or what is remaining in his hand. So he's losing out on a lot of money. So, and no one likes to pay six-figure taxes to the IRS. And this kind of tax strategies are the most prestigious and rich people in the country are using. And people wonder, okay, they must be stealing money. They must be doing something wrong. No, they're not doing anything wrong. They are utilizing the tax strategy, which rest of the population doesn't even know about it, and they're not using it. So, how this family endowment program.
Let me interrupt you for 1 second. If you go back to that slide again.
Mm-hmm.
I get to hear from many people, like my accountant is already taking care of this, maybe like they're working with attorney, and then they start explaining that they have like a trust where they have transferred the money and they're not paying any tax. But what they are missing is this is not very complex structure that we're talking about. On top of that, it's not just simply transferring to trust. It's very different. And it offers you the cash flow, a disposable cash flow that you can utilize right after you go through this transaction, plus additional 5 years of charitable contribution deduction. So it's very different. It's not similar.
Yeah, thank you for adding that, Taruna. So give me just one moment. I think I lost my slide. Okay. So if you're wondering, there are so many capital gain tax strategy and how this family endowment program compares to the other strategy. So, I have this whole comparison here. Like, as you saw in my previous example, FEP is eliminating taxes now. You don't pay now, you never pay in future. However, monetized installment sale. It's better tax efficiency, no taxes due in 30 years, no uncertainty of what tax rates will be again in 30 years. Monetized installment sales are long-term one. And charitable deduction for approximately 85% of the assets contributed subject to valuation. So no interest income and interest expense to report on individual tax return for 30 years at all. But at the end of 30 years, depending on whether you're alive or not, you may have high tax liability or you are inheriting your tax burden to your kids. Charitable remainder trust. Again, with the charitable remainder trust, it's a little bit better tax efficiency, typically much greater charitable deduction and less tax over term of trust, reduced distribution to and more flexibility over distribution to charities, but more flexibility and control over investments. It does not really eliminate your taxes. I mean, it will eliminate taxes up to a certain extent. However, you don't get control over money, how you want to spend, or you want to invest in another business and whatnot. So the only thing that can be done is the charitable causes and whatnot, right? The family limited partnership. It's better tax efficiency, initial tax deduction and tax-free income or gain, less complexity valuation risk than the family gifting or estate planning, eliminates estate taxes and generation skipping transfer tax, but there will be still, if this in the family limited partnership, if your heirs were to get any shares, something were to happen to you, they will pay high taxes. Whereas in family endowment program, if your heirs were to get inherited with the family endowment program, they get that exact same benefit. 1% is taxed, 99% is completely tax free. 1031 exchange. 1031 exchange, again, as you all know, you have to invest in the like kind investment. And many times you are just tired. You don't want to get again into that same type of investments. It allows for deferral of the taxes to the future date. But why would you defer the taxes when we can completely eliminate? So, there are a couple other things with the ERISA, qualified plan, private foundation, offshore trust. Many of these tax strategies available. If one tax strategy offers tax deferment, then it's locking down with the similar kind of investment in the future. If it offers tax elimination, then there is a full restriction on how money can be used. You cannot use that money to invest in another business or for any other purposes. And if at all, if this money is passed over to your kids in future, they will pay high taxes on that as well. However, with the family endowment program, taxes are eliminated completely today. At the same time, you have the full freedom. What kind of charitable causes you want to support, how much you want to give to charitable organizations, what other different buckets you want to utilize your money in. Maybe portion with the stock market, portion giving it a loan to your family members or whatever, or maybe investing in real estate business or buying another business. Whole lot of different options. So if you were to do this FPP post sale, which means you have already sold your business, after the fact, if you were to do this, it's a possibility as well. It's not as beneficial as the first one, but let's look at it. Client has an asset that client wants to donate to charity. This includes cash from the sale of business or stock option proceeds, so it can be another asset. Client establishes FEP based upon the needs of the client. Assets are transferred into the family endowment program in exchange for the client owning 1% voting interest and 99% non-voting interest. And client transfers the 99% interest to the qualified public charity. A valuation of the assets transferred into the family endowment program are valued by an independent appraiser, and client receives charitable deduction for the value of the 99% of transfer to the FEB. So as you can see here, we have multiple licensed professionals involved, whether we call an independent property value appraiser or independent tax attorney or a CPA. We have a team of CPAs and licensed professionals who come as a team, and every one of them are independent of one another. So if that you can be rest assured that the things are handled to the best way it is possible. Otherwise, this many licensed professionals will come together as a group. Now, client manages the assets of the family endowment program as the voting owner. Any investments in the FPP can be managed by the client or client's advisors, and any gains from earning in the entity are taxable at 1% to the client. So if we were to take an example, let's say Paula's federal marginal tax rate is 37%, and effective long-term capital gains and net investment income tax rate is 23.8%. She sold her business and is seeking to contribute 1.25 million into the family endowment program. She will transfer the cash into the FEP in exchange for a 1% voting interest and 99% non-voting interest. The non-voting interest is transferred to the qualified public charity, which is valued for this particular example purposes at 85%. At 37% tax rate, the potential tax savings from the charitable deduction is $353,000. So if I were to look here, income taxes in the year of sale, if she does not do anything, is $297,000 versus doing with the FEP, 1% off whatever it is here, which is $2,975. After tax cash flow, if she doesn't do anything, after paying her taxes of $297 after $1.2 million, she has $952,000 remaining in her hands. With the FEP, getting extra charitable deduction with the reduced taxes and everything, she is keeping $1.2 million in her hands, even after doing the FEP. That's the additional cash flow that is generated, and she's keeping that money in her pocket. So let me give you a live example of one of my clients, Samina Shah. We have full permission from her to share this case study. If we don't have the permission from our clients, we do not share any client case study like this publicly. But so meet my client, Samina Shah. Her parents owned 3 hotels, and they have been victim of their, of the huge fraud by their hotel manager. So she took over handling accounting and tax area due to her parents' aging, and had bad experiences with multiple accountants and tax lawyers, and almost lost her faith in accountants. Missed filing the 1099 forms, operated under the wrong entity structure, and many expenses were not even reported on her tax returns. So she had always seen her parents paying $100,000 to $500,000 in taxes while growing up. She comes with us on board, and our team helped her to bring her situation back on track. We helped her devise the right strategies. We reviewed business tax structure and corrected erroneous filings by amending previous year's tax return, which resulted in a refund of $70,000. The refund that she had never seen growing up. First time ever she got the refund. And not just that, we eliminated capital gains taxes on hotel sale by customizing her tax planning. So, she just sent us an email when we told her that this is how much refund you're expecting. She's like, I haven't seen a refund since I was like 20 years old. Fascinating stuff. No, some people are so used to paying high taxes and never seen reduced tax liability or never seen tax refund. This is definitely a fascinating stuff for many of them. So in 2020, when they planned to sell one of the 3 hotels for about $2.5 million, and that hotel was fully depreciated. That was built by her dad in 1980s. And so that full $2.5 million will be completely treated as capital gain because there is no basis remaining in that hotel. And living in California, they were expecting 37.10% of taxes on the sales proceeds of $2.5 million, which is 20% of capital gain tax, 3.8% of surcharge. On top of that, California state taxes, which is almost about $927,000 in taxes. They did not qualify for 1031 exchange because they wanted to use their sales proceeds for building out another hotel, which was already in construction. So when you have another hotel, which is already in construction, you cannot do 1031 exchange because that property does not even exist, before doing 1031. So our team of qualified professionals devised strategies that eliminated almost 100% of tax on this 2.5 million hotel sale. And not just that, when I created that case study and I posted on social media, someone said, this seems to be a shady post. So Samina came over and she's like, this numbers points out exactly where it is written in this case study. So let me show you that comment because, sometimes people think that this is not even possible. So here it is. This KJ Singh posted it and Samina felt compelled to identify herself. When I post on social media, I don't identify my clients. But she felt compelled that, I need to respond to this comment. And she's like, KJ Singh, I'm actually the client this exact example pertains to. And Minal's team includes an independent tax attorney and my personal estate planning attorney. And I will attest to this not being a shady post. The numbers pencil out how it is described above. And I do not believe anyone could get this many independent legal professionals to make something up. And not just that, and she kind of, goes on and on. She's like, how our team helped with detangling the mess, reduce her tax liability, protect her legally, give her a team of resources that she can depend on, as well as providing COVID-related support. And on top of that, she's like, please private message me. I'm happy to discuss how Minal and her team gave me a big part of my life back. And not just that, the biggest and the most important thing, she herself is an accountant. She has worked for Ernst & Young, Big Four international public accounting firm for 12 years. So, and the reason I'm saying this, you may have a very well-meaning qualified accountant, but certain things, not every accountant knows it. What we do is not something that we are taught in our CPA curriculum or, in our accounting degree. This is the higher designation, higher study that we have done because we don't want any other family to suffer like my dad did. So some of the frequently asked questions that I usually get on the family endowment program, I just thought I will add in all here so that you get the full information. Who has the control of the assets in the FEP? The client, who are the general owner, who are the 1% voting partner, per the entity agreement, has a full control of the assets in this entity. And who assigns the money manager for the family endowment program? Again, client, who has a 1% general owner voting power, will assign the money manager, which could be themselves or someone else. How can I get tax opinion letter for the family endowment program? We have identified attorneys who have been vetted for the program and for a fixed fee can provide you with an independent tax opinion letter. And how can I get the valuation for the charitable gift into the family endowment program? Again, we have an independent certified valuation expert. We have a bunch of them, depending on who is available and have the fastest turnaround for, depending on what state client lives in. We give you a recommendation as well on that. And who determines which charities the family endowment program can give to, and how does this process work? The client who is 1% voting owner or general owner determines what charities that receive charitable donations, and the money is transferred into the donor advised fund at the discretion of the client, and the client determines the charity that receives the proceeds. So let's go over, Prana, is there any questions from our attendees? If you have any questions, I would love to cover those questions and go over that. So I
do see question.
Go ahead.
What are the costs involved to set up to invest for FEP?
That's a very good question. The cost involved for the FEP, depending on how much assets you are transferring inside the FEP, we have the company that we are using right now for the FEP. They used to charge 6.5% of the asset value, which they have discounted for because we have been dealing with so many of our clients and giving a lot of business on that side. So they have discounted for all of our clients 6% flat rate for up to $5 million in asset transfer. So anything above $5 million, again, their rates drop down further. So, and I'm more than happy, if you, have a situation where you have high capital gain and you want to get a full picture, okay, what it will look like in your situation, including the cost, tax savings and whatnot, reach out to my team and we are more than happy to do that, analysis for you.
And on top of that, they've been doing this for many years without any issue.
Yes. And this strategy have never been audited. Never been audited. I'm not promising that this will not be audited in the future as well. But from the audit protection side of things, like opportunity zone, conservation easement, and all of that have high audit risk compared to the family endowment program.
I would say 99% chances. Okay, the next question we have, how much actual donations do we have to make?
Yeah, very valid questions. And, that question came in my mind as well when I was introducing this tax strategy initially to my clients. Um, the There is a good thing and a bad thing. The good thing is IRS does not define how much tax donations to make, which is a good thing because then you have the discretion. You don't have to go with the very high donations. The bad thing is then it leaves you to the dilemma. How much should I donate or whatnot? Ideally, based on our experience, anywhere from 3 to 5% of the asset value is good enough per year. So every year we would say maybe 3 to 5% of the asset value just donated to your desired charitable entity organization, which is a fraction of the dollar compared to what you will donate to the IRS, by the way. Any other questions, Sarana? I think you're muted. I cannot hear you.
Okay, we have one more question. Thank you very much for this webinar. It is still not clear to me how the client will use certain amount of net cash flow proceeds from the FEP investments to pay for its own lifestyle needs.
Okay, let me just go over that. It is not clear to me how the client will use certain amount of net cash flow proceeds. Okay, very good question. So, there are multiple ways to utilize or take the money out of the FEP.
Okay, sorry to interrupt you. I think the first question that we should think about is how would you support your lifestyle needs if you were to pay capital gain tax that you will be paying without utilizing FEP? So think about that. In contrast, Minal will explain further.
Yeah, definitely a valid question on that side because once the money is donated to the IRS, it's never coming back. It's gone forever. However, with the FEP, there are multiple ways. Like say, for example, you can take portion of the money every year as a management fee. You can give this money as a loan to other businesses that you own at a promissory note. And eventually, if you want, you can also have self-debt canceling promissory note in future as well. There will be minimal taxes on that, but again, you will be taxed on a smaller chunk if you were to cancel out that debt versus paying taxes on a huge chunk of money. So that can be planned out ahead of time. My clients who does the FEP, they never want to close that company because you can never get anywhere else 1% tax on all the taxable income. So there are multiple ways. I kind of tell my client, use the cash flow inside the FEP as your own cash flow bank. Instead of you going out in the market to get some cash from the bank for any of the business or personal financial needs, get that exact loan from your FEP company or invest that money, as if you got the loan from the bank. But very good question.
Another question I have, cost to work with you for tax planning.
It depends circumstances to circumstances, depending on how complex your situation is, how involved the tax planning strategy is, and what combination of tax strategies we are doing. It depends on client to client. However, we are very selective in, with whom we really work. I only take in the client if we can find sizable tax savings for you. If I cannot find any tax benefit, I just like to tell you up front that there isn't any opportunity because I don't want to waste your time and my time.
I think that's about it. You did very well explaining all facts related to FEP.
I see one question from Amul, for how many years to donate? IRS does not say anything, but because you are getting a huge charitable deduction, which is available to you in the year this FEP transaction happens, and it's available to you for the next 5 years to carry forward. So we kind of recommend as a best judgment to donate for at least 5 years because you are getting some charitable deduction at least for 5 years or altogether 6 years. So I would say, 5 to 6 years, maybe 3 to 5% of your total asset value, which is available year after year, do that much of donation just to be on a safer side. I just kind of tell when IRS gives you so many tax benefits and all these tax loopholes and deductions, do it in a way where even if you have to donate some money, don't be afraid because otherwise you would have been paying high taxes either way. So If you're paying too much of taxes, and if you feel like you don't even know if you're paying too much taxes, or if IRS is really scaring you, and if your CPA is afraid of the IRS, because we are not, and if you feel like you are one bringing new ideas to your accountant rather than your accountant bringing you new ideas, we have an exclusive offer for the attendees of this webinar. We are offering exclusively for the attendees of this webinar a free tax assessment. We have very limited spots available only for the next 2 weeks. And use this link to schedule up a tax assessment with my team. And our team will tell you exactly how much you're overpaying in taxes, what specific tax strategies can you use in your situation, and how to implement your strategies moving forward. We will tell you how much you overpaid last year, how much you are on a track to overpay this year, as well as how much you are on a track to overpay next year. So we don't do this often, but just as my bonus gift, only exclusively for all the attendees of this webinar, if this is something you are interested, we have a very limited spots available. So take the advantage of this opportunity.
Before you end, Minal, Amul have one more question, and I think that's what goes in everybody's mind, just adding numbers quickly to see what is the net result or net ROI, if you want to address that.
Okay, so what Amul is saying, 6% of the assets for the FPP fees, 4% donation per year for 5 years, then it is 20%. 20%, totaling 26% we are paying. So total saving is only around, okay, I think Amul, there is some confusion here. 4% donation per year for 5 years. So keep in mind, the first year you may have maximum asset value within the company, and you are paying 4% of that. Second year, your assets have reduced. You may have given out some money as a promissory note, or you may have taken as your management fees. So your assets are reduced. That 4% will be on the reduced balance. The next year, again, another 4% will be on a reduced balance. So year after year, you have reduced balance. So it's not in reality 20% straightforward. At the same time, instead of paying huge chunk to the IRS upfront, you are paying in small chunk, but at a very small rate. And then in future, when you're doing that 4%, you are also getting, in addition to that, what we call a charitable deduction, which is available in the year of sale as well as next 5 years. So that's also a huge benefit. On top of it, I would like to add, in the year of FPP, instead of paying taxes at 23% or 24% plus whatever your stage taxes, depending on what stage you are on, you're only paying taxes on 1% of the gain, which could be 0% capital gain tax rate, because your income tax bracket is in the lower threshold. At the same time, your state taxes would be very minimal as well. So I hope I have addressed your question, but if you have any other question, feel free to reach out to me or my team. And once again, I would like to thank everyone for joining us today. I know we covered a lot of information, and I hope it was informative. Stay well and be safe. And I will see you again on another webinar in next 3 weeks.